Margaret Holloway is sitting at her kitchen table in Toledo, Ohio, sorting mail the way she has every Tuesday for 40 years. She's 68, retired 2 years ago from a school district accounting office, and she opens an envelope from the Social Security Administration expecting the usual cost of living notice. Instead, she sees a number that makes her set down her coffee cup. Her Medicare Part B premium isn't the standard amount her neighbor pays. It's over $200 more every single month for the entire year. She does the math on a sticky note. $2,400. Gone. Not because she did anything wrong, because 2 years ago, before she retired, she was still earning her full salary. And Social Security is still charging her today based on income she isn't making anymore. This is a fictional illustrative composite story, not a real identified person, but the mechanism behind it is very real. And it is quietly draining retirement checks across the country every single month. Name the trap. Here's what almost nobody tells you when you retire. Medicare doesn't look at what you earn today. It looks at what you earned 2 years ago on a tax return you may have filed before you even stopped working. If that old number looks like a high earner's income, Medicare charges you a high earner's premium, even if your real income has since dropped by half. Insiders sometimes call this quiet, backward-looking billing the 2-year ghost. It's ironic, really. You spend decades being told to save aggressively for retirement, and then the very year you finally slow down, the system charges you as if you never did. Hey, I'm Jordan, and this channel is all about helping you protect the retirement you worked your whole life to build, the traps, the paperwork, and the fixes nobody hands you at the retirement party. If that sounds useful, consider subscribing, because we cover one of these hidden mechanisms every single week. Before we go further, I want to be straightforward with you. Everything in this video is general education, not personalized legal, tax, or financial advice. Your situation has its own details. So before you act on anything here, talk to a licensed financial advisor, a CPA, or directly with the Social Security Administration. What I can do is walk you through how this system actually works and what documented options exist to fix it. The mechanism? Explained up. Let's slow down and actually understand what's happening. Because once you see the mechanism, it stops feeling random and starts feeling fixable. Medicare. Part B, which covers doctor visits and outpatient care, and Medicare Part D, which covers prescription drugs, both have a standard monthly premium that most retirees pay. But there's an additional charge layered on top for higher earners, officially called IRMAA, the Income-Related Monthly Adjustment Amount. The idea behind IRMAA isn't unreasonable on its face. It asks retirees with higher incomes to shoulder a bit more of the cost of the program. The problem is in the timing. The Social Security Administration doesn't have real-time access to your current income. So instead, it uses your modified adjusted gross income from your tax return 2 years prior. If you're turning 65 or enrolling in Medicare this year, the government is often looking at a tax return from when you were still working full-time, still collecting a salary, maybe still receiving bonuses or stock vesting. That return can push you into a higher IRMAA bracket, sometimes by just a few dollars, which can mean paying a meaningfully higher premium for both Part B and Part D for a full year, regardless of what you're actually earning now. Here's the part most retirees never learn. The Social Security Administration has a built-in escape valve for exactly this situation. It's a form called SSA 44, officially titled Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. This form exists specifically so that when your income has dropped because of a recognized life event, retirement or work reduction, the death of a spouse, divorce, loss of pension income, or a few other qualifying circumstances, you can ask Social Security to recalculate your IRMAA using your current, lower income instead of that 2-year-old tax return. This isn't a loophole. It isn't aggressive tax planning. It's a documented administrative process built directly into how Medicare premiums are calculated, designed for the exact situation millions of new retirees find themselves in every year. But because it requires you to proactively file paperwork rather than something that happens automatically, an enormous number of eligible retirees simply never learn it exists. And they keep paying the higher premium month after month, sometimes for years, without ever knowing there was a form for this. The stakes here aren't abstract. For some retirees, correcting an IRMAA determination can mean the difference between a comfortable monthly Medicare bill and one that eats meaningfully into a fixed income. And because the surcharge applies to both spouses on Medicare in a household, the compounding effect on a couple's combined retirement budget can be significant. 3-scenario comparison. Let's look at how this plays out differently depending on the situation, using illustrative numbers only. Your actual IRMAA bracket and premium will depend on the current year's official Medicare figures and your specific tax return. Scenario 1, a single retiree in Arizona who retired mid-year. Their last full working year showed household income well above the standard bracket. Without filing SSA 44 in this illustrative example, they might pay several hundred extra dollars a month in combined Part B and Part D surcharges for the full following year, even though their actual retirement income is now solidly middle class. Scenario 2. A widow in Pennsylvania whose husband passed away last year. Their joint tax return from 2 years ago reflected 2 incomes. Now she's filing as a single retiree, living on 1 Social Security check and a modest pension. In this illustrative example, without correcting the record, Medicare could still be billing her IRMAA based on the old joint household income. A mismatch that, once documented with SSA 44 and proof of the life-changing event, can be corrected going forward. Scenario 3. A retired couple in Florida who both stopped working in the same year and proactively filed SSA 44 as soon as they enrolled in Medicare, submitting documentation of their retirement dates and estimated current income. In this illustrative example, their premiums were assessed against their new, lower retirement income from the start, avoiding the overpayment entirely rather than needing a correction later. The pattern across all 3. The government's default assumption is your old income. The burden is on you to prove otherwise. Nobody calls you to say, hey, your income dropped, let us adjust your bill. You have to raise your hand. The solution plus live math payoff. So what do you actually do about this? Here are the commonly recommended steps, in plain terms. And again, for your specific paperwork and numbers, work with a financial advisor or directly with your local Social Security office. First, know your qualifying event. SSA 44 only applies to specific life-changing events: work stoppage or reduction, marriage, divorce or annulment, death of a spouse, loss of income, producing property beyond your control, loss of pension income, or an employer settlement payment. If your income drop falls into one of these categories, you likely have a legitimate basis to file. Second, gather your documentation early. This typically means a copy of your most recent tax return, evidence of the life-changing event, a retirement letter, a death certificate, divorce paperwork, and a reasonable estimate of your current year's income. The more organized your paperwork, the smoother the review tends to go. Third, file the SSA 44 form directly with the Social Security Administration, either by mail or in person at a local office, rather than waiting for an automatic annual review. Timing matters. Filing as soon as the life-changing event occurs, or as soon as you enroll in Medicare, can prevent months of overpayment rather than requiring a retroactive correction later. Fourth, put a review on your calendar. Income situations change, a required minimum distribution, a Roth conversion, a part-time consulting gig, and any of these can push you back into a higher bracket the following year. A periodic check-in with a financial advisor about how your income interacts with IRMAA thresholds can help you plan withdrawals and conversions with this in mind, rather than being surprised by next year's premium notice. Now let's put this into a simple illustrative comparison. Picture 2 composite couples, both retiring the same year, both with nearly identical retirement income going forward. Family A does nothing. They assume Medicare figures it out automatically. Their premiums are set based on their final working year's income, and they never file SSA 44. In this illustrative example, they overpay a combined several $100s a month between the two of them, for roughly a year and a half before the standard look-back period catches up to their new lower income on its own. Added up, that's potentially several $1,000s that simply left their retirement budget for information they didn't have. Family B does one thing differently. As soon as they retire, they file SSA 44 with proof of their retirement dates and their new expected income. In this illustrative example, their premiums are corrected to reflect their actual current income within a couple of months, and they never overpay in the first place. Same retirement, same income. The only difference is one form, filed at the right time. That's the entire trap and the entire fix in one sentence. The government assumes your old income unless you tell it otherwise, and telling it otherwise is a form away. If there's one thing to take from this video, it's this. Don't let a 2-year-old tax return decide what you pay for healthcare today. Check whether SSA 44 applies to you. If you know someone who just retired, just lost a spouse, or is about to enroll in Medicare, send them this video. They may be overpaying right now without any idea why. If you found this useful, subscribing helps you catch the next hidden trap before it costs you. I'm Jordan, and I'll see you in the next one.